Welcome to Lesson 5, Part 8. We are going to talk about sensitivity to transaction costs. First, recall that trade system returns are also expressed as gross figures. That's why the net returns depend on a few operating factors. The financial vehicle involved, ETF, futures, or contract for difference, and the characteristics of the financial market involved and of the broker itself. Also, the order of magnitude of the notional value might have an impact in terms of net returns. The basic sensitivity analysis presented in this video aims at dealing with such factors. The aim of this analytical step is to quantify the net returns by means of a multiplication factor, by means of a netting factor. In Lesson 4, we carried out a sensitivity analysis to deal with sample variability. In this video instead, the focus is on the operating cost variability, namely the transaction cost variability. So, let's see how this netting factor works. Let this factor be Fnet1. If our trading system has a gross expectancy of exp0, we get the net expectancy exp1 multiplying the former by the netting factor. This factor, of course, is a number ranging from 0 to 1. Recall from Lesson 4 what the transaction cost consists of. We highlighted the prevalence of the bid-ask spread. Then we are going to focus on that. The bid-ask spread depends on the financial issue involved, but there is a bit of unpredictability related to possible insufficient market depth or temporary liquidity shortage. When these two occur, a netting factor might have to be revised to the downward, let's say from 0.98 to 0.95. That is why a sensitivity analysis has been brought in. Market depth related to a financial issue is the amount of liquidity available to safely fill the market orders, where safely means without impacting the price of said financial issue. That is a characteristic of both the financial issue and the financial market involved. Besides, sometimes, for instance upon news releases, a temporary liquidity shortage might occur regardless of the characteristics above mentioned. On top of that, liquidity is going to be sufficient or not depending on the position size, on the notional value of the trade. A big position size, schematized at the bottom of this picture, is more likely to raise issues such as the widening of the bid-ask spread. That, in turn, begets higher transaction costs. Liquidity shortage also might have an impact on the time taken by the market to fill our order. It would take a longer time for the sake of precision, and within this extra time, the market might go against our position. That is referred to as slippage, which can be assimilated to a higher transaction cost. Let's see a real-life example referring to the greedy long strategy on gold. The x-axis in this chart is meant to model different scenarios. The tick 0 on this x-axis refers to the unrealistic case of no transaction cost at all. It is just to show the gross figures of our performance metrics. We have just two performance metrics here, the profit factor and the terminal wealth reality, which are going to be discussed in lesson 6. Well, the tick 1 on the x-axis, marked with the orange vertical line, refers to the standard condition, which means no liquidity issues at all. In that condition, we would have a netting factor of nearly 0.977. That accounts for a bid-ask spread of 2 basis points, compared against an expected trade return of 67 basis points, and accounting also for the position size normalization discussed in lesson 4. The tick 2 on the x-axis refers to a scenario where issues arise and a transaction cost have to be multiplied by a factor of 2. The tick 3 refers to a scenario where even bigger issues arise and a multiplication factor of 3 has to be taken into account, and so on. Well, in the example schematized here, accounting for double transaction costs begets a netting factor of 0.954 instead of 0.977, which was the standard case factor. Netting factors in this chart are plotted as the light blue slanting line, which decreases as the cost multiplication factor increases. In order to make it clearly visible, though, what we have plotted here is not the plain factor, but its double. The light blue line, then, it's 2 times the netting factor. For a qualitative analysis, that is enough. If we want accurate figures, we have to switch to the sensitivity analysis report in the next slide. This table provides the accurate figures reported in the previous slide. The last column of this table delivers a break-even analysis as it recounts up the smallest cost multiplication factor, which completely undermines profitability. Here, we can also account for costs 5 times bigger than they are in standard conditions, and the trading system will still be profitable. That is an extremely satisfactory outcome. Thanks for watching, and see you at Lesson 5 Part B for the final component of the sensitivity analysis tier.